Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the setups Wall Street doesn't want you to see until it's too late. Today, we are diving deep into one of the most explosive, most misunderstood, and most potentially rewarding trades sitting right in front of us in this market. We are talking about BitMine Immersion Technologies, ticker symbol BMNR, a company controlling over 4% of all Ethereum, getting crushed 90% from its highs, and yet, somehow, top-tier Wall Street analysts are absolutely pounding the table with strong buy ratings. So before we get into all of it, the assets, the catalysts, the derivatives playbook, and the exact trade setup, make sure you hit that subscribe button right now, because this is the kind of deep dive analysis you only get here on Smart Stock Sam. Here is the overarching question this entire video is going to answer. How does a company sitting on $12.3 billion in assets trade like a penny stock in freefall? And more importantly, is the market completely wrong right now? Could a single calendar date just a few weeks away force billions of institutional dollars into this stock, whether Wall Street wants it to happen or not? Here is what we are covering today. First, the raw asset picture and the massive disconnect between what this company owns and what its stock says it is worth. Second, the staking operation turning that crypto treasury into a cash flow engine. Third, the $4 billion buyback signal. Fourth, and this is the one that could catch a lot of people off guard, the forced institutional buying event locked in on the calendar. And finally, the exact trade setup, the specific price levels, the options play, and the stop losses you absolutely cannot ignore. Let's find out. Right now, BMNR is trading in the $19.25 to $19.34 range. On the surface, that looks depressing. After all, this stock once traded at $161 a share. A 90% drawdown is devastating by any measure. But here is what the surface-level chart does not show you. Over the last 12 months, BMNR is actually up 75%, while retail investors have been staring at that ugly, long-term mountain and cliff chart and running away in terror. Something very different has been quietly unfolding underneath. The stock has been building a higher floor. It has been stabilizing, and if you know what that kind of price action looks like, you already know what comes next. This is what institutional accumulation looks like. Big money buying the blood while everybody else is too emotionally scarred to look at the chart. The question is, are you going to be on the right side of that trade, or are you going to be the one selling them the shares? Now, to understand why institutions would be accumulating a stock that is down 90%, you have to understand what they are actually buying. BitMine is holding exactly 5.39 million Ethereum. Let that number breathe for a second. 5,390,000 ETH. That is 4.47% of the entire circulating supply of the world's second-largest cryptocurrency. At current prices, this brings their total asset base to $12.3 billion. $12.3 billion. And yet the stock is trading near $19 a share. How is that possible? Because Ethereum has been getting absolutely brutalized near the $2,000 psychological support line, and Wall Street algorithms are doing exactly what algorithms do. They see the Treasury declining in paper value, and they hammer the equity. The result is $6 to $8 billion in unrealized paper losses sitting on the books. And the word you need to burn into your memory is unrealized. These losses are not locked in. They are not permanent. They are a synthetic price distortion created by macro fear and institutional ETF liquidations, not by any fundamental failure of the business itself. But here is the part that separates BMNR from every other crypto treasury zombie company out there. Management is not sitting in a boardroom watching their asset base bleed and hoping Ethereum bounces. They are engineering their way out of this. And the first piece of that engineering is something called the Maven Validator Network. Instead of letting 5.39 million ETH sit in cold storage collecting nothing, BitMine has deployed 73% of it, roughly 4.71 million ETH, into active staking. They are validating the Ethereum blockchain and getting paid for it. Think about what that actually means for a second. Every time an Ethereum transaction gets finalized, every time a block gets added to the chain, BMNR's validator network is part of that process, and it collects a fee for doing so. This generates an estimated $264 million to $276 million in annualized staking revenue every single year, even if Ethereum flatlines for the next 2 years, even if the crypto market goes completely sideways and nothing moves an inch. This yield machine keeps spinning, funding operations, absorbing overhead, and fueling the next catalyst we are about to talk about. $250 million a year in passive income is not speculation. It is infrastructure. It is a moat. It is the reason this company does not need a bull market to survive, and why the bulls believe it is already positioned to absolutely thrive when one inevitably arrives. Now let's talk about the $4 billion signal. When a management team authorizes a $4 billion share buyback program, they are not doing it for fun. They are not doing it to make a press release look good. They are doing it because they believe, with absolute conviction, that their own stock is criminally undervalued. A buyback of this size on a stock trading near $19 is a screaming, neon-lit declaration that the people who know this company best think it should be worth dramatically more. And from a mechanical standpoint, every dollar deployed in that buyback is a dollar-absorbing selling pressure in the open market. It creates a permanent mechanical bid under the stock. So, while retail investors see a scary chart and bail, the company is literally down there on the other side of the trade, buying everything they can get their hands on. And then, on top of all of that, on top of the $12.3 billion in assets, on top of the $250 million in staking yield, on top of the $4 billion buyback, there is something coming on June 26th that changes the entire equation. This is the hidden catalyst. The one that the average retail investor scrolling past this ticker has absolutely no idea about. Earlier this year, BMNR successfully uplisted to the New York Stock Exchange. As a result of that uplisting, they have been added to the preliminary inclusion list for the Russell 1000 and Russell 3000 indices. Now, if you have never heard of the Russell reconstitution before, let me explain exactly why this is a massive, massive deal. Trillions, with a T, trillions of dollars, are managed by passive index funds that are mathematically required to mirror the exact holdings of these indices. When BMNR officially joins the index on June 26th, every single one of those passive funds is mandated, not suggested, mandated to buy BMNR stock to match their weighting. They do not care about Ethereum's price. They do not run a DCF model. They do not read the news. They just buy, mechanically, algorithmically, inevitably. This is a forced buying event baked into the calendar, and it is coming in just a few weeks. Let's talk about what the options market is telling us right now, because the smart money always leaves fingerprints, and right now, those fingerprints are impossible to ignore. In late May, over 210,000 option contracts were traded on BMNR in a single session. 66% of them were calls, bullish bets, and the real concentration, the cluster that should have your full attention, is sitting at the $20 call strike expiring in August 2026. In options theory, a strike with this level of open interest functions like a gravitational magnet. Market makers who are short those calls need to buy the underlying stock as it approaches that level to hedge their exposure. This creates what traders call gamma squeeze pressure. The closer the stock gets to $20, the more stock market makers are forced to buy, which pushes it closer to $20, which forces them to buy more. It is a self-reinforcing mechanical cycle. And right now, the entire option structure is pointing at that $20 target like an arrow. Now let's look at the underlying asset itself, because BMNR is a proxy for Ethereum, and you cannot trade the proxy without understanding the base. Here is where things get genuinely interesting. In the spot market, Ethereum looks terrible. It is hovering in the low 2000s, beaten below every major daily moving average, surrounded by a cloud of retail panic. But flip over to the derivatives market, and you see a completely different picture. The max pain options strike for Ethereum, the level where option buyers lose the most and market makers collect the most, is sitting at exactly $2,000. The put-to-call open interest ratio is 0.62. Do you know what that means? It means derivatives traders are loading up on long calls, not protective puts. They are not hedging for a crash. They are positioning for a rip. On top of that, open interest on Ethereum futures just hit a record high of over 16 million ETH contracts. The smart money is not panicking. The smart money is quietly, aggressively loading up on upside exposure while the retail crowd liquidates in fear. So why is the price still bleeding if derivatives traders are so bullish? This is the critical piece of the puzzle. Over a span of 12 to 14 consecutive trading days, institutional investors pulled $695 million out of spot Ethereum ETFs. That is relentless, mechanical selling pressure from the very funds that are supposed to be bullish on crypto. Day after day after day, those red outflow bars kept printing. And what happens when you have relentless institutional selling in an asset that is simultaneously facing macro headwinds from rate uncertainty and geopolitical tension? You get exactly what we have seen: a slow, grinding bleed that makes every technical bounce look like a trap and shakes out every retail investor who cannot stomach the pain. Until that reversal comes, until those daily flow bars flip from red to green, any rally attempt in Ethereum is going to hit a wall of institutional supply. This is your primary prerequisite. Before anything else triggers in this trade, you need to see ETF outflows reverse to inflows. That is the green light, and it is also the single most important number to watch on your Bloomberg terminal or wherever you are tracking capital flows. When the big money stops selling and starts buying, the setup unlocks overnight. Now let's bring in one more layer of the fundamental picture, because BMNR is actually more diversified than most people realize. Beyond the Ethereum Treasury, they hold $444 million in pure cash. They hold 203 Bitcoin. They hold a $95 million stake in 8Co Holdings. And here is one that people are sleeping on: a $200 million equity stake in Beast Industries, a company that is projecting $1.6 billion in revenue this year alone. Chairman Tom Lee has publicly called this dip a generational entry point. Standard Chartered's macro analysts are projecting Ethereum to hit $4,000 by the end of 2026, and a figure so large it sounds almost fictional: $40,000 per ETH by 2030, driven by the institutional tokenization of real-world assets. The analyst consensus right now sits at a strong buy, with an average price target of $34.50. From current levels, that is nearly 79% upside. One more detail worth noting: insider ownership sits at a microscopic 0.2%. That means the public float is enormous, which makes the stock extremely reactive to institutional inflows, and that Russell reconstitution just became even more impactful. Now here is the part of the video where you actually learn how to trade this. For the BMNR equity position, your entry zone is strictly between $18.80 and $19.27. That is your accumulation window, right on the base building support structure. Your first immediate target is $20 to $20.50, that options magnet we talked about. But discipline is everything here. You must have a hard stop loss sitting at $17.50. If BMNR closes a trading day below $17.50, the base is broken, and the bottoming thesis is invalidated. Get out. No arguments. For the more advanced traders in the audience, you can generate income on this position right now by writing cash-secured puts at the $18 strike, collecting elevated premium courtesy of the high implied volatility. Or if you want pure directional upside exposure, the August 2026 $20 call options are where the smart money is already concentrated. For trading the Ethereum beta directly, your entry zone is right on that max pain strike, between $1,970 and $2,010. Your price target is a return to major resistance at $2,120 to $2,150. And the absolute line in the sand, the trapdoor you must not fall through, is $1,840. A weekly close below $1,850 does not just mean a bad week. It triggers a cascade. Margin calls force liquidations, which force more margin calls, which could send Ethereum spiraling down toward $1,560 in a very short time. If that level breaks, you close the trade, you step aside, and you wait for the dust to settle. No ego, no averaging down. The stop loss exists for a reason. Now, before I give you the final verdict on this setup, I want to be direct with you about something important, and this is the part of the video you should always pay close attention to on any financial channel. Everything discussed in this video is strictly for informational and educational purposes only. Nothing here constitutes personalized financial advice, investment recommendations, or a solicitation to buy or sell any security. Stocks and cryptocurrencies are highly volatile instruments. You can lose 100% of your capital. Past performance, analyst price targets, and derivative signals do not guarantee future results. Always consult with a qualified financial advisor before making any investment decision. Do your own research, understand your own risk tolerance, and never invest more than you are prepared to lose entirely. Smart stock. Sam does not hold a financial advisory license, and this video is not a substitute for professional advice. With that said, here is the logical conclusion of everything we covered today. BMNR's severe price depreciation is synthetic. It is a function of macro crypto market fear and ETF outflows dragging down a proxy equity, not a reflection of a fundamentally broken business. The company is generating over $250 million in annual staking yield. Management has authorized a $4 billion buyback, screaming undervaluation from the rooftop. The derivatives markets on both BMNR and Ethereum are heavily skewed toward upside. And in just a matter of weeks, a forced, algorithmic, calendar-driven buying event from the Russell Index reconstitution is coming whether the crypto market cooperates or not. The upside dramatically outweighs the downside, provided, and I cannot stress this enough, provided you respect those stop losses and watch those ETF flow numbers like a hawk. Now here is the question I want you to answer down in the comments right now. Do you think the Russell Index inclusion on June 26th is enough to push BMNR through that $20 option ceiling before August expiration? Or does Ethereum need to reclaim $2,000 first for any of this to matter? Drop your take below. I read every single comment, and I genuinely want to know where you stand on this one. If this breakdown gave you any new perspective on how to think about crypto proxy equities, please hit that like button right now. It takes 2 seconds, and it helps this analysis reach more people who need to see it. If you are not subscribed yet, hit subscribe and the notification bell so you never miss a setup like this one. And if you really want to support the work we do here on Smart Stock Sam, YouTube has a super thanks feature right below this video. Even a small contribution goes a long way toward keeping this level of research free for everyone. Stay disciplined, protect your capital, and I will see you in the next one.